Hello and welcome to another episode of our educational video series, The Learning Curve. Today, our focus is on capital gains tax, which has always been a subject of research. It's critical to keep an eye on the calendar when you sell your house. If you don't time it well, you may end up paying a hefty amount as tax. If a property is sold within 3 years of buying it, any profit from such transaction is treated as a short-term capital gains in the hands of the individual. This is added to the total income of the owner and taxed according to the slab rate applicable to him. However, if a house property is sold within 5 years of the end of the financial year in which it was purchased, the tax benefits claimed may go out of the window. That is, tax benefits which were claimed earlier will have to be reversed. The tax deduction claimed for the principal repayment, stamp duty and registration under Section 80C are reversed and the amount becomes taxable in the year of sale. Only the deduction of the interest payment under Section 24B is left untouched. That is why, from the tax point of view, it is advisable to hold the property for at least 3 years. If you sell a property after 3 years, the profit is treated as long-term capital gain and taxed at 20% after indexation. Indexation takes into account the inflation during the holding period and accordingly adjusts the purchase price, thereby slashing the tax burden of the seller. There are other benefits too. The owner can claim various exemptions in case of long-term capital gains, but no such benefit is provided for in case of short-term gains. Expenses incurred on repairs and renovation can be added to the cost of acquisition of the house while computing long-term capital gains. Also, the interest paid during the pre-construction period of the house can be added to the cost if not already claimed as deduction earlier. There are several ways to manage your tax liability when you sell a house. There is no tax to be paid on the gains if you use the entire gain from the transaction to buy another house within 2 years or construct another house within 3 years. The 2 and 3 year period applies even if you buy another house a year before selling the first one, but the property should have been bought in the name of the seller. If only a part of capital gains are invested, then the balance amount is charged to long-term capital gains tax. However, the entire tax exemption will be reversed if the new property is sold within 3 years of purchase or construction. In such a case, the entire capital gains from the sale of the previous house will be considered as short-term capital gains and taxed at the normal slab rates. If you are not keen to lock in your gains from sale of house in another property, there is another way out. You can claim exemption under Section 54EC by investing the long-term capital gains for 3 years in bonds of the National Highways Authority of India and Rural Electrification Corporation Limited or any other notified organization within 6 months of selling the house. However, one can invest only up to Rs 50 lakh in these bonds in a financial year. Apart from this, sellers also have the option to set off the long-term capital gains from sale of the house property against any long-term loss from sale of other assets. These can be losses carried forward over the past 8 years or even those incurred in the same year. However, to avoid tax on short-term capital gains, the only way out is to set it off against any short-term loss from the sale of other assets such as stocks, gold or another property. What are TDS requirements? To plug tax leaks, the government has now made it mandatory for buyers to deduct TDS when they buy a house worth over Rs 50 lakh and above. TDS of 1% of the value of the property is to be deducted before making payment to the seller. Make sure that the buyer deposits the amount with the tax authorities on your behalf so that you can claim credit for the payment. Till last month, this amount was required to be deposited within 7 days from the end of the month in which the sale transaction was done. But from June 1, the period has been extended to 30 days. Since this payment is made on behalf of the seller and linked to the seller's PAN, it is reflected on the seller's Form 26AS under the head Part F, usually within 7 days. The seller must also obtain a TDS certificate in Form 16B from the buyer. The seller can claim a refund of the TDS if he incurs loss on the sale of house or if he is claiming exemption from long-term capital gains under any of the ways mentioned earlier. To claim the refund, he should provide details of investment of the capital gains in his tax return. Else, he can also obtain a certificate from the assessing officer specifying that no TDS must be deducted on payments made to him and present this certificate to the buyer. Taxpayers selling their house will find the following tips handy. If the cost of the new residential property is lower than the total sale amount, then exemption is allowed proportionately. The remaining amount can be reinvested under Section 54 EC within 6 months. The exemption is still allowed even if the builder of the new residential construction fails to hand over the property to the taxpayer within 3 years of purchase. The capital gains will be calculated on the basis of valuation adopted by the state's Stamp Duty and Registration Authority. The tax department may object to it if the actual sale value is lower than the valuation of the property by the state authority. If you are unable to reinvest the gains in another house or bonds before filing your tax return for the year in which the sale takes place, deposit the balance in the capital gains account scheme so that you are eligible for the deduction. Thank you for watching TIOL Tube. You may send us your feedback or suggestion to make it more useful for you at editor@tiol.in.